Then we will move over to shipping. Obviously, marine transportation had a fantastic post-COVID year last year. A lot of inventory builds and a lot of high commodity prices obviously impacting positively. The one segment though that didn't really benefit last year and still is struggling are the crude tankers. So I think we're gonna focus on those today because that's where we see the most interesting developments, I think, going forward. So if you start by looking at spot rates, obviously they are and have been at extremely depressing levels basically since the third quarter of 2020. VLCCs last year had the most difficult year ever, basically, in modern times, averaging, I think, for a standard non-eco vessel, you were basically below OPEX for the full year of 2021, and no different the start to 2022. Right now, we're seeing, of course, two things happening. We're seeing one, that fuel costs are higher, benefiting modern tankers. So we've seen in the reporting season now for Q4 and in the guiding for Q1 that the companies with modern vessels with scrubbers are outperforming quite substantially. And of course, the second thing we're seeing now is that these tragic events in Ukraine and what that does to Russian exports is having a devastating impact on obviously the oil market, but also impacting the tanker market. And what's really happened to begin with has been, of course, a marked uptick in rates for smaller crude tankers. So Suezmaxes here on the right, on average now above $60,000 a day. So it's not only the exports out of the Black Sea that are commanding high rates. We also see it spread to other regions, the Mediterranean, in general West Africa as well. Aframaxes, so not depicted on this slide, but rates there also have gone sky high. If we look a little bit specifically on Russia and Russian oil exports, of course, those volumes are and have been crucial to Western markets. This chart here shows the seaborne exports by destination. And of course, if you look on Europe as a whole, it's around 3 million barrels per day of Russian crude oil, just about 2 million that is seaborne. We've seen U.S. refineries take quite a lot of Russian seaborne crude in 2021. How will we now see this impacting? I think Nadia touched upon it earlier, but of course you're seeing that the oil is becoming discounted and no one is really daring to buy. So where the initial reaction to crude tanker markets have been very positive, it's been a positive jump in rates. We're seeing maybe that over time this should ease off if Russia is not able to find buyers for its crude. So in sum, we think that overall, in the long term, a trend where Russia will send its oil cargoes predominantly to Asia from the same regions. There's still going to be exports out of the Baltic Sea, out of the Black Sea. If that's going to happen on smaller tankers to Indian or Chinese refineries, of course, it's going to be great for ton miles. It's also going to mean that Europe will have to import more of its crude from the likes of Brazil and West Africa, which again is better than seeing it go from short haul in Russia. So over time, I mean, the impacts now are devastating. It's tragic, but over time this can be a positive twist to crude tankers, even though we think right now the jump in spot rates is a little premature and unlikely to last. When we look ahead then, I mean, there's been a lot of talk on when we will see oil demand and when we will see seaborne transportation demand be back at pre-COVID levels. It looks as if it's going to happen before year-end 2022 now. So when we look at the chart here on the left is showing ton mile growth, obviously a lot of volumes disappearing overnight almost in the second quarter of 2020. Last year was disappointing. I mean, there was an increase in overall volumes, but that's largely been due to OPEC slowly coming back, and that's not really having a positive effect on ton miles. So ton mile growth last year wasn't really up a lot, but that effect is happening this year. First and foremost, as OPEC is slowly coming back, but back half of this year we expect U.S. US exports to rise steadily on the back of higher production there. And that's going to be a super interesting trend in the years to follow. The chart to the right here is showing how seaborne trade is doing now versus on a volume basis versus where we were pre-COVID. And we can see the dark blue line is showing crude oil, so crude tankers. The steady line there, the 12-month moving average, was still some 6-7% below where we were pre-COVID, but we're also now becoming on a monthly level, we're actually 6-7% above where we were a year ago. So we are seeing positive developments here. We are seeing that things are starting to pick up, and the ignition we now had out of Russia has certainly contributed positively as well, and showing that the market, because VLCC rates have gone from basically 0 to 35,000 for, again, a modern ship almost overnight, so it's not completely oversupplied, this market, and we think it will continue to gradually improve through the year. Now, the most interesting part of the tanker market is really the supply dynamics, and it's really the lack of ordering. I mean, there's been very little ordering recently, but also, and perhaps more importantly, the high number of older vessels we still have trading. I mean, this is really a consequence of all the vessels that were built 20 years ago. And in 2022, we can go 20 years back and say that there's a lot of more vessels built 20 years ago than what we could 5, 6, 7 years ago, because they built more vessels in the early 2000s than they did in the mid 90s. And these vessels are now struggling. I mean, they're becoming older. We're seeing 2002, 2003 built vessels being scrapped. And then going forward, there will be a lot more vessels hitting this age. So when we look at the order book today, it's about 7% of the existing fleet, which is then roughly, you roughly have 4 times as many vessels being above the age of 15, and we now also have roughly 50% more vessels above the age of 20 versus the what we have on order. And this is unusual. This is something we haven't really seen either in modern times. And then it's encouraging to see that scrapping activity is actually happening. Last year was the highest in the years in terms of tons sold for demolition since 2005. Second highest, of course, after 2018. And the year is starting off relatively good as well. Of course, higher steel prices, higher scrap prices, contributing positively. We think even the Ukraine, tragic, again, Ukraine war now can have a positive impact on scrapping volumes, because there's a lot of steel going normally from the Black Sea to the Med, which now is likely to be disrupted, that trade. So we think scrapping activity will continue, both because of higher scrap prices, but also, of course, because of regulations coming. And that's the second thing that is also going to impact the supply dynamics. From January 2023, we're seeing these new regulations coming. The IMO is taking making an effort here to improve the emissions from the global fleet. So from January 1st, 2023, there's the new EEXI regulations that are limiting how much carbon you can really emit. And going forward, this will be reduced. So a vessel really now built before 2008 can be struggling already from 2023. And as we go along, the requirements will be tougher. You're not necessarily going to see 2008 built vessels scrapped, but they're going to be forced to go slower in order to comply with emission requirements. And that's, of course, going to reduce the effect, how effective the tanker fleet can be. When we look forward then, of course, also at the new building prices, this is great news for all of shipping. General inflation, shipyard inflation is fantastic. VLCC now is costing between $100 and $120 million, depending on your spec and your yard. That's up almost 50% versus the bottom we had in 2018. It's pushing up resale prices, it's pushing up second-hand prices. But still, we see that second-hand values are at a big discount to new build parity. That's going to flip as soon as earnings increase. As soon as rates go back, you're going to see second-hand values at a premium to new build parity, which of course is going to push NAVs upwards. The second thing that this does is, of course, also pushing up your return requirement. So where you needed $39,000 a day over the past decade to defend ordering a VLCC if you need a 10% return, you now need $45,000 a day. So this is, of course, when the market is tough, you see less speculative ordering. We haven't really seen any speculative ordering in the tanker space. That's why the order book is 7%. That's why the order book is less than what we have above the age of 20. So in effect, we can see very little fleet growth. And the good thing here is if the market does pick up Q4 this year and into 2023, the order books are still quite full. We've had a lot of container vessels ordered, we had a lot of LNG carriers ordered, so we have good visibility in any kind of market scenario for 2023 and 2024. So when we then look at our forecasts, we expect tanker rates to slowly improve. We think the spike we see right now is mostly noise. We think the good market will come from 2023 at $50,000 a day. That's EV/EBITDA sub 3, for example, for a company like DHT. It's below 5 for a company like Frontline. And $50,000 a day then, again, is really what you now need in order to order a vessel. So this is, in our view, giving good visibility, good risk reward. It's a lot of volatility in the market right now, but we think that the tanker market will be super interesting going into 2023 and 2024.